Welcome back to Investing Talk Podcast.
Today we're looking at Devon Energy.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For this one, we really wanted to focus on a very specific question.
Right.
How is one of the biggest players in U.S. shale fundamentally changing how it actually makes money?
And that's the core mission here. We're not just looking at another E&P company that's all about chasing volume.
No.
We're talking about Devon Energy. They're already a free cash flow machine, and now they're in the middle of this massive plan to just, expand margins, almost regardless of what oil prices do.
Exactly. And to really get it, you have to start with their foundation. It's just so high quality. Devon is, focused on oil, natural gas, NGLs, but their real strength is where they operate.
The Tier 1 basins.
The Tier 1 basins.
Yeah.
The Delaware, the Eagle Ford, the Anadarko. When you hear those names, you should just think lowest cost, highest quality rock in North America, period.
And their recent numbers, they totally back that up. Their output metrics have been consistently hitting the high end of their own forecasts.
Right.
I mean, Q3 oil production was right at the top of their guidance, about 390,000 barrels a day.
And total output is even more impressive.
Yeah, when you factor in everything else, they're looking at something like 844,000 barrels of oil equivalent per day. It's a huge operation.
And that operational muscle, it translates directly into cash. That's the part we love to see.
Correct.
In a recent quarter, they pulled in, about $1.7 billion in operating cash flow. And more importantly, that free cash flow number was $820 million.
That's the money left over after everything, after all the bills are paid and all the new wells are drilled.
That's the cash that can go back to shareholders. And this machine is just running so efficiently right now.
What really stands out to me is the discipline they show with that cash.
Yeah.
So many E&Ps, they get a windfall and they just immediately plow it back into drilling more, chasing growth.
Devon's not doing that. It's a different approach.
It really is. Through the first 3 quarters of 2025, they generated over $2.4 billion in FCF.
An incredible number.
And they sent more than half of that, about $1.27 billion, straight back to shareholders. Dividends, buybacks, you name it.
That shows a real strategic discipline, returning capital, not just spending it because you can.
And none of this works, of course, without a strong balance sheet to back it up.
Oh, absolutely not. They operate with some of the lowest some of the lowest debt compared to their peers. And in this sector, that is just essential.
Why is that so crucial for an investor to understand?
It's all about volatility, right? Oil prices go up, they go down. Low debt is your insulation. It means you're not sweating when WTI dips for a month or two. It gives you that financial flexibility.
Okay, so that's the baseline. Great assets, disciplined management, already printing cash. But the real story here, the thing that gets interesting, is this huge structural shift they're pushing through.
The billion-dollar plan.
The billion-dollar optimization plan. They're targeting a full $1 billion in annual free cash flow improvements by the end of 2026.
And I think we have to emphasize again, this is not about volume.
No.
This is all about margin expansion, making every single barrel they pull out of the ground more profitable.
So $1 billion that's a massive number. You have to ask, how much of that is just, wishful thinking for a PowerPoint slide versus actual quantifiable stuff?
And that's a fair question, but when you break it down, it's actually very granular. It's built on 4 levers.
Okay.
The biggest piece, $300 million, is from capital efficiency. Basically, optimizing how they drill wells to reduce what they call cycle time.
Which is just the time from when you start drilling to when oil starts flowing.
Exactly. Cut that time, you cut the cost per well. Simple as that.
Faster wells, same output. Got it. What's next?
Next is $250 million from production optimization, and this is a big one. It tackles the biggest problem in shale, which is that steep decline curve.
Right. A new well's production just falls off a cliff after a few months.
It does. So they're using tech and data to flatten that curve, to keep wells producing at a higher rate for longer. That reduces the constant need to spend on new replacement wells.
That is a huge deal. That replenishment cost is what kills the FCF for so many other companies.
It's a game changer if you can crack it. Then there's another 300 million from what they call commercial opportunities.
Which is really just a scale advantage, right?
It is. They're so big they can negotiate better deals on pipelines, on marketing, everything. It just lowers their per barrel cost compared to a smaller guy.
And the last piece.
150 million from just, corporate cost reductions, trimming the fat. But here's the kicker. Here's why this isn't just a promise.
They're already doing it.
They're way ahead of schedule. By the middle of 2025, they had already achieved over 60% of that billion-dollar target.
60%. That's incredible. It's basically de-risk at this point.
It is. Management is saying about 300 million of that total lift will be fully baked in by the end of this year, 2025. It's happening right now.
So the implication for you as an investor is pretty clear. They're planning to keep production flat into 2026 while reducing how much they spend.
Pure operating leverage. The cash flow growth comes from efficiency, not from just spending more money to get more oil. That is resilience.
It means they're set up to be profitable even if oil prices took a serious dive.
So moving past the financials, let's talk about the competitive moat. What really separates them? Because, anyone can drill a hole in the ground.
Right. It starts with the land, though. That concentration in Tier 1 basins, it's like owning all the best real estate.
It's beachfront property in the energy world. It just gives you this deep inventory of low-cost drilling locations that work even in a sort of mid-cycle oil price environment.
But the really surprising part, the part that feels like a true tech edge, is what they're layering on top of that great land.
Right. The data and analytics side of it, they're being really aggressive with automation and this proprietary tool they built called DVN.
DVN. It's basically their own custom AI, a large language model built specifically for oil and gas.
Think about it. When you drill a well, you generate just petabytes of data. Seismic data, pressure data, fluid data. No human can possibly analyze all of that effectively.
It's impossible.
So DVN sifts through all of it in real time. It looks for patterns. It helps them optimize how they complete the well. It's finding these small efficiencies that add up to millions of dollars.
It's a compounding cost advantage that a smaller operator who can't afford to build a custom AI just can't compete with.
No way. And that tech advantage loops right back into that 300 million commercial opportunity. Their scale lets them invest in the tech, and the tech locks in their scale advantage. It's a virtuous cycle.
And the final piece of that moat is just their philosophy, their capital discipline.
It really is. The market has, time and again, punished E&Ps that chase growth for growth's sake. Devon's focus on flat production and just maximizing FCF, it really sets them apart as a quality operator in this new era for U.S. shale.
Okay, so this all sounds very, very clean. The fundamentals are strong. The billion-dollar plan is well underway. Which brings up the obvious question.
Why is the stock down?
Exactly. Why have we seen this weakness in the share price recently?
And we have to be honest about that. The stock's been down, 4 to 6% over the last month. But when you look at why, it's pretty clear this is a sector-wide issue.
It's not a Devon-specific problem.
Not at all. It's about general oil price volatility. It's about geopolitics. It's about macro fears, like new supply coming online from Venezuela. It's everything but the company's actual performance.
And when you look at it from a valuation perspective, that weakness starts to look like, well, an opportunity.
It really does. The consensus view out there suggests a fair value somewhere between, say, $41.80, $45.80 a share.
And the stock's been trading in the mid-30s, so that's what, 15 to 20% upside from here?
At least. And if you dig into the relative valuation, how it trades compared to its peers, it gets even more interesting. It's currently trading at about a 30% discount on an EV to EBITDA basis compared to the peer group.
Okay, let's break that down for a second. EBITDA. Why is that the metric to watch here?
It's just the standard for energy because it cuts through the noise. It looks at the company's total value, its enterprise value, and compares it to its core cash profits before things like debt payments and depreciation.
So a 30% discount means?
It means the market is giving them way less credit for every dollar of cash profit they generate compared to their competition.
Which suggests all that macro risk we just talked about is probably already priced into the stock.
I think so. It creates a really interesting risk-reward setup, especially with the stock sitting in that $35 to $37 support zone.
But let's play devil's advocate. What's the bear case? What's the primary risk here?
The biggest threat is always the oil price. For any E&P, if WTI were to somehow fall and stay below $60 a barrel for a long time, that would hurt.
The classic commodity risk.
It is. But again, you have to go back to that billion-dollar plan and their low debt. That is their insulation. They are specifically building the company to be resilient in that kind of low-price world in a way that most of their peers are not.
And we need to hit on that shale decline rate one more time. That constant need to reinvest just to stay flat is the big challenge for this whole industry.
And that's what's so brilliant about their plan. They are directly attacking that problem, that $550 million inside the plan that's dedicated to capital efficiency and production optimization.
Yeah.
That is their weapon against the decline rate. By getting more oil for less money from they lower the amount of capital they need just to maintain production. And that flows straight to the bottom line as sustainable FCF.
Okay, so let's look forward. What are the near-term catalysts? What could actually trigger a re-rating and close that valuation gap in the next, say, 3 to 6 months?
The next quarterly earnings report is going to be massive. The market will be watching like a hawk for an update on that billion-dollar plan.
They need to see the progress.
They need to see the progress. They need to see confirmation of the 2026 capital return framework. What's the pace of buybacks? What's that dividend going to look like?
And management commentary outside of the earnings calls, too.
Yeah.
At investor days and conferences.
Absolutely. We'll be looking for more detail on how things like DVN are actually saving them money in the field. They need to keep hammering home that message. Flat production, lower capex, higher FCF.
And you can't ignore the macro picture.
You can't. If inflation cools and central banks start signaling rate cuts, that's often a huge tailwind for a cash-generative value stocks like this one. You could see that 30% discount close very, very quickly.
And finally, there's a little long-term nugget in there, too. Their exploration of hydrogen initiatives. It's speculative for sure.
Oh, very speculative. It's not driving the stock today. But it shows they're thinking about the future, about the energy transition, and it gives them some long-term optionality.
So, to sum it all up,
Yeah.
what's the takeaway for the person listening right now?
The investment thesis here is it's really compelling. You have this rare combination of top-tier, low-cost assets and a fully funded, already successful optimization plan.
Which means they're set up to grow their free cash flow per share, the real measure of value, even if oil prices just kind of stay flat.
Exactly. That structural efficiency story is a true differentiator in the shale patch. So the recent weakness, driven by macro fears, it really does look like a compelling entry point for a re-rating over the next 1 to 2 years.
Does it just keep proving that the billion-dollar plan is real?
Right. And the provocative thought I'd leave you with is this. If this model, this flat production extreme efficiency model, proves to be a huge success and the market rewards it, will it force the entire E&P industry to finally abandon that old growth at any cost mindset? That's a really big question here.
That is definitely something to mull over. Thank you for joining us for this analysis of the energy sector. We encourage you to subscribe to the podcast to ensure you don't miss future market breakdowns.